There's a retirement lie almost everyone believes, that you can just work longer and you'll be fine. But the numbers and the markets say otherwise. Because when millions of households get this wrong, it doesn't just wreck retirements. It shifts interest rates, credit spreads, and even which equities lead. This is Global Notes by JP. Weekly, no-hype macro you can actually use. Subscribe if you want second-level thinking that connects household fears to market risks. 64% of Americans fear running out of money more than death itself, and they have reason to. In 1960, you had 5 or 6 workers funding each retiree's Social Security. Today, it's closer to 3. By the 2030s, it'll be closer to 2. That math doesn't add up unless something changes. At the same time, life expectancy in advanced economies has jumped more than 13 years since 1960. That's a massive win for humanity, but a structural shock for retirement math. For most of the 20th century, retirement was a 3-legged stool: Social Security, pensions, and savings. That stool is now missing a leg. Defined benefit pensions covered 63% of full-time workers in 1989. Today, only about 15% of private workers have one. In their place came 401ks, great when markets rise, brutal when they don't. Here's the problem. Sequence risk. Retire in 2000, your nest egg shrank 30% in 2 years. Retire in 2010, it doubled in the next decade. Same saver, same plan, completely different life outcomes. And now, Washington is letting alternative assets, private equity, private credit, even crypto, into 401ks. Wall Street calls it diversification. For households, it usually means higher fees and less liquidity when you need it most. On paper, working longer helps twice. More contributions in, fewer years drawing out. But in reality, half of retirees leave work earlier than planned. Health shocks, layoffs, or age bias make work longer an option only for the lucky. And the labor market isn't designed to wait for you. Skills depreciate. Industries evolve. Employers don't always want you when you need them most. That's why just work longer isn't a solution. It's a myth. This isn't just a household story, it's a macro story. When millions of retirees face sequence risk together, their consumption swings reshape demand in recessions. When target date funds rebalance at scale, it quietly tightens financial conditions. When home equity stops being the bailout, as younger generations are priced out, downturns hit harder. And every year Congress delays on Social Security reform, the eventual fix gets bigger, faster, and more market-moving. So what would reform actually look like? There are really 3 levers. First, raise more revenue. Lift the payroll cap so higher earners contribute on more of their income. Second, reduce benefits at the top. Adjust cost of living formulas or bend points so lower-income retirees are protected, but the wealthy get less. Third, raise the retirement age, a stealth benefit cut because people work longer to qualify. Here's the trap. Reforms tend to shield the poor and barely touch the wealthy, but they hollow out the middle. If you make $40,000, you're protected. If you make $400,000, you don't care. But if you make $80,000, teacher, nurse, or manager, you contribute fully, yet your benefits get trimmed or delayed. Once again, the middle class becomes the shock absorber of the system. So what actually works? For households, front-load your savings rate. Bigger base capital matters more than exotic assets later. Reduce fragility. Cash buffers and emergency credit lines beat chasing 60 extra basis points. Rebalance by risk, not age. Treasuries still hedge growth shocks better than private credit. Delay claiming Social Security if you can. It's the cheapest longevity hedge you'll ever get. Reskill mid-career. Because the true retirement option is having the ability to work, not just the will. For policy, stabilize Social Security sooner with small, gradual changes. Enforce guardrails on 401k alternatives, cap fees, mandate transparency, build aging workforce infrastructure, tax-advantaged retraining, strong age bias enforcement, and portable benefits. So yes, younger Americans will probably work longer than their parents. But averages hide the truth. The ability to work longer is unevenly distributed. A resilient retirement system doesn't assume you can work longer. It plans for when you can't. For markets, this isn't a slow burn story. It's a catalyst. Sequence risk, Forced de-risking and delayed reform are not household problems alone. They're macro risks waiting for the wrong cycle. If you found this useful, like the video, share it with a friend who still believes in the work longer solution. And subscribe for more macro insights. Thanks for watching.